Let's begin with what we're seeing with the equity markets right now, because on the one hand, we have Wall Street on this record run, but then on the other hand, we have China now actively looking at market stimulus measures, perhaps a rescue package by another name. Is this the Big Bang stimulus that China traders have been looking out for?
Well, I wouldn't call it the Big Bang stimulus. It's a reminder of how downbeat expectations are for the region and for the stock markets. I mean, it's certainly not insignificant news, and is helpful, but the scale of it still, I think, falls short of something that could really sustain an equity market recovery. But as I say, such as the depths of sentiment that this size of stimulus, this modest size of stimulus, could be helpful for markets. I think what the markets would look for a more durable recovery would be something that would really sort of support consumers and really help the housing market, which this isn't. But at the margin, yes, it's helpful, and no wonder markets are taking a bit of a pop.
Yeah, so a short-term sugar pop in the arm. In that case, though, Ben, do you think the Chinese equity rout gets worse before it gets better?
Well, it's difficult to call. I think we'd be sort of pretty neutral on it, but there's certainly risks. Yeah, I think as the market sort of tires of this sort of targeted technical stimulus to try and infuse investors and sentiment, the rally could certainly fade. I think what the market, as I said, wants to see is something that would be more durable, would help the consumer, would help reignite and ameliorate the sentiment that has challenged a really difficult and extended period for the housing market, and that hasn't really been forthcoming of scale. But market pressure may need to increase in order to trigger that. But Chinese policymakers might be resilient to that, so it could be a difficult period. I mean, getting house prices firing again isn't necessarily top of their agenda. Of course, housing affordability is much more of a priority for them.
Yeah, absolutely fair. And I think you make a really good point there, Ben. Let's shift focus over to the BOJ as well, which is another major market headline today. No change in the policy. However, we saw an interesting update to the forecast on CPI. Do you think it offered any clues on when BOJ might actually exit ultra easy policy and hit the normalization button here?
Well, I mean, it did offer some clues, but of course, the Bank of Japan has something of a history of surprising us, so getting too focused and fixated on the clues could be a bit of a misread. But certainly the clues suggest the exit from negative interest rate policy. We may have to be patient on that. I think they want to see more. Inflation is certainly in a better position than it has been for a while, but what we're seeing in terms of direction of travel at the margin on inflation isn't necessarily so helpful, and I think they want to see more evidence of sustained wage pressure before exiting. So I think the clues, if you like, and the market has sort of taken a lead from it, is that we need patience, and maybe you're looking towards the summer now, rather than April, for the first interest rate hike.
Okay, interesting to watch. And hey, Ben, I was talking with another portfolio manager yesterday who kind of weighed in on the outlook for the year ahead. With regards to the strategy here, this person told me keep an overweight exposure to fixed income in portfolios versus neutral for equities. I think it's interesting because you take a bit of an opposing view here. Can you just expand on the strategy in the year ahead?
Yeah, we better have a face-off with this other portfolio manager. No, we take a slightly more positive view at the moment. Look, I think we recognise that pulling off a soft landing is a tricky thing to do, and is only a temporary state anyway. It might transition from soft landing to recession, but for the time being, disinflationary narrative looks well supported, and resilient growth looks like an outcome as a result, coupled with incrementally easier policy. I mean, that mix, of course we could get volatility given the strength we've seen, but that mix, it's hard to get bearish at the moment.